US stocks are trading down ahead of chipmaker Nvidia's results later this morning. Australia's inflation in July was stronger than expected, while house building remains soft and there's ongoing weakness in New Zealand's jobs market. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung explains why there's been record high outflows of capital from China in recent quarters.
Not only the FDI or the foreign investors start to pull out the money out, but also the domestic Chinese companies also send a lot of money from China to the offshore market.
But first, in 5 and 5 with ANZ, US stocks fell overnight ahead of key earnings data from AI chipmaker Nvidia. That's coming up this morning, and that's set to drive the direction for stocks this week. At 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.6%. Meanwhile, on the global interest rate outlook, European money supply growth at 2.3% annually in July came in below market expectations and is actually negative in real terms, which ANZ head of G3 Economics Brian Martin says supports the ECB's ability to cut rates again in September.
Furthermore, the credit data that are published with the report were also very weak in real terms. Loans to households rose 0.5%, which, when adjusted for inflation, means they were really quite negative. Loans to non-financial corporations rose 0.6%, again, when adjusted for inflation, really quite negative. And what the data are saying is that the restrictive monetary stance that the ECB put in place in response to the record high inflation is having a rapid and forceful effect on subduing demand in the economy via the monetary channels.
The US dollar index firmed overnight. It's up 0.57% at 4 a.m. Sydney-Melbourne time. That meant the Aussie dollar was trading down 0.3% at 67.73 US cents. And the Kiwi down 0.25% at 62.34 US cents. Number 2, Australia's partial inflation indicator for July rose 3.5% from a year ago. That was slightly above market expectations, but down from 3.8% in June. ANZ senior economist Catherine Birch says the drop was caused by temporary electricity price rebates from the federal and state governments, which are skewing the headline figures.
I guess you could call it artificially and temporarily dampening headline inflation. And that's why some of the core measures, in particular trimmed mean inflation, is going to be a much more accurate reflection of what inflation is actually doing in Australia. And the RBA knows this and they will be focusing on that as well. Electricity prices didn't fall as much as we expected in the month. There will likely be more pretty steep falls coming.
Number 3. Catherine says the key data point to watch now, and potentially over the next year, is trimmed mean inflation. That came in at 3.8% after spiking to 4.4% back in May.
The trimmed mean inflation was not affected by the rebates, so it is much more a measure of underlying inflation and gets rid of some of the more volatile price changes. But the fact that it's declined to a 6-month low and is coming down from that high we saw a couple of months ago suggests that that underlying disinflation is resuming after that bit of re-acceleration that we saw earlier this year, which is similar to what we also saw in the US at the start of the year.
Number 4. Australian construction activity rose only 0.1% in July and was up 1.2% from a year ago. ANZ head of Australian economics Adam Boyton says large engineering projects, particularly in the public sector, look to be hitting capacity, meaning growth is difficult from here. But he says residential construction remains soft.
New housing construction or new residential work done, they call it in the release, was down 0.2% in the quarter. That tells us we're still not building many new homes in Australia. There was a little bit of growth in alterations and additions, but look, overall you'd say the level of residential work done or housing that's being built is still probably too low to keep up with where population growth is currently running at in Australia.
Number 5. Across in New Zealand, monthly employment data shows a 0.1% fall in filled jobs in July. That's the 4th monthly decline in a row. ANZ senior economist Miles Workman says the data shows previous tightening by the Reserve Bank of New Zealand is working.
It is, in absolute terms, weak data, but it's not, I would say at this stage at least, weaker than we have been expecting. But certainly plenty more water to flow under that bridge over the coming months. There are certainly risks that the labour market starts to turn south a little bit more aggressively than we're all expecting, but so far the July data don't suggest that is happening.
Miles Workman there. Now, in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, analyses recent outflows of capital from China by both foreign and domestic investors.
I think what caught the market attention was the net capital outflow of foreign direct investment. That's the data from the balance of payment statistics from China, the liability side of direct investment. So we call it foreign direct investment because there's a foreign entities investing in China. Record $14.8 billion net outflows, which is probably the second quarterly outflow we have seen in history. And the first one was the third quarter 2023. But then we also note that our direct investment, that's the asset side of the direct investment of this balance of payment, also reported $71 billion outflow. So it means that not only the FDI or the foreign investors start to pull out the money out, but also the domestic Chinese companies also send a lot of money from China to the offshore market. So that's it's a very interesting number, and that's also reflect that, well, maybe we need some other explanation apart from the supply chain realignment or geopolitics. There might be some macro factors behind the cross-border flow of the direct investors.
Yes, because, on the face of it, we have the US interest rates likely to fall, and from a yield point of view, not quite so obviously attractive to Chinese investors looking to move money offshore. But why do you think there has been this shift in local money moving out?
Now, the past few years had seen a very, very high US dollar interest rate in the offshore market, and that's apparently induced a lot of cross-border flow. On trade, we know that has encouraged a lot of renminbi cross-border settlement so that they can enjoy by depositing the same amount of money in the offshore account. Through this type of trade financing arrangement, they can earn, some decent basis point gain from the trade settlement. On investment, we also see that there have been lots of affiliate lending between onshore entity and offshore entities because of the high US dollar interest rate in the offshore market. Typically, we see that a lot of the Chinese companies, they have many entities or financial arms or financial companies set up in Hong Kong. And so that could facilitate some of the intercompany lending between the onshore parents and offshore entities. So when I look at the data of the balance of payment data of this direct investment, much of this outflow was in the form of affiliate lending. So it tells us that the high interest rate and the gap between the Chinese interest rate and the US interest rate had induced a lot of this type of flow. But now, obviously, we know that after the Jackson Hole conference and the US will begin to cut interest rate, begin to ease the monetary policy condition, and that might have some impact, this type of cross-border flow that apply not only to the Chinese investor, but also to foreign investors, because many of the foreign investors, they also maintain an office in Hong Kong or other offshore markets.
There's been an unwinding somewhat of the yen carry trade, and there were some similar dynamics, although obviously it's the Japanese interest rates that are rising at the same time as US interest rates falling, whereas we're not seeing Chinese interest rates rising. But is there the potential for a version of the yen carry trade unwind moving to the Chinese currency?
That is always possible, but obviously now you see that the Bank of Japan started to hike as well and finish to end their negative interest rates in Europe. Whereas in China, know that there is still a downward pressure domestic interest rate. Obviously that what happened in Japan, the last decade, 30 years ago, now started to happen in China. And if the same property downturn had happened in other countries, just as the US subprime or the Japanese bubble burst, then we should have seen a negative interest rate scenario in China. But obviously the People's Bank of China, the Chinese central bank, still hesitate to cut interest rate. That they don't believe in monetary policy easing, or they are worried about the impact of monetary policy easing to build up some other financial bubbles. So the chance for China to see a very, very low interest rate still very small. Now, but of course, we do expect that another 10 basis point cut after in the second half of the year, or maybe the coming few months after the cut in July.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 29th. Catch you tomorrow with further analysis from Raymond on why changing global supply chains mean Chinese factories are shifting that money out of China. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.